Hi, I'm Mike Gassewitz, CEO of TriCert Financial Group. Welcome to another episode of InFocus. Today we're going to talk about the finance sector. Joining me today is Lee Grimshaw, our portfolio manager responsible for this sector. Welcome, Lee.
Thank you, Mike. Glad to be here.
Great to have you on the show. Okay, let's talk about the financial sector and basically how have our picks done from a business perspective?
Yeah, so the picks overall, we've had some very solid picks in the sector, both from a bank perspective and from a general. I guess the other two concentration areas are the insurance side and the life insurance in particular, and the general. There's sort of a general finance sector which Berkshire, as an example, fits into. And they've all had great results. Berkshire just reported on the weekend, knocked it out of the park. And most of the life insurance picks have been doing well because of the declining interest rates. And the banks generally have been performing well because of the GDP and sort of, let's call it, the miss, so to speak, in terms of the fear factor of having a recession in either Canada or the US. And so they've done generally well. Now there's a bit of a difference in geography, which I think we'll talk about, but generally speaking, across the entire sector, it was one of the hottest sectors across all the sub-indexes within both the S&P 500 and the TSX.
Okay, so all good news. So let's talk about then how has the market reacted?
Yeah, so in rough terms, the Canadian sector returned about a 30% ballpark return for 2024. The American sector produced about a 40% return. So there was a material difference between the two sectors, but both were highly positive. And that's largely because of the GDP results that came out of the American economy. And the fact that really when I think about, and I think this is general knowledge, that when you think about the banking sector in particular, it's a leveraged play on GDP. So what do I mean by that is that the revenues are highly correlated with nominal GDP. As that filters through a P&L statement, a profit and loss statement, you get a leveraged effect on the profits. And so in the States, they had a much more material and stronger GDP, as most people recognize. And so as a result, their numbers were better. And as a result, stocks tend to follow results. And they had a stronger quarter, a stronger year, I should say.
Okay, so from a multiples perspective, let's talk about Canada versus the U.S. Like, let's say from a multiples perspective, do they track, or do the U.S. warrant a higher price, or?
The U.S. right now warrants a higher price, more particularly in certain sectors, in particular the ones with the huge capital markets exposure. So they've shown tremendous growth, and that's because of the perception of deregulation that Trump will impose, which in fact he is successfully imposing upon his administration. And so that's certainly tracked. The Canadian banks are tracking. It's a bit of a tale of two tapes. The banks with the higher U.S. capital markets exposure, and in particular that's Royal, which is one of our core picks. It's TD, which is one of our core picks, and it's BMO, which is not one of our core picks, but very much might be in the near term. So those banks have done particularly better than the other banks within Canada. National Bank is a bit of an outlier with respect to that comment, because they've just done extremely well in a very strong Quebec-based economy. So they've actually been one of the leaders in the banking sector in Canada, and so that would be the only outlier. But they're all tracking. The Canadian banks are tracking more closely to the historical averages and trading ranges, whereas the U.S. banks, in particular Goldman Sachs, Morgan Stanley, and J.P. Morgan, are a little bit outlying with respect to their multiples.
Okay. Any standouts you want to focus in on?
Well, those are really the ones that I just talked about. Goldman
Right.
Sachs, Morgan Stanley, they're your pure play capital markets providers.
Right.
Canada just doesn't have a pure play capital markets provider. They have more like a bunch of JP Morgans in Canada, and I think we've named those names. But they were the real standouts. And then on the insurance side, the insurance sector, because of the hard and soft market, and I think we've talked about this in a previous podcast, they've been standouts as well. So Arthur J. Gallagher, Berkshire, both had really standout returns. And in fact, just looking at it quickly, Arthur J. Gallagher was 38%, and Lee Berkshire was roughly about 38% as well. So pretty good returns at the end of the day. Not quite as good as the finance returns, but pretty strong returns irrespectively. The other ones are actually on that point, Brookfield Asset Management, which is a private equity type of play. They had a 50% return in the Canadian context, so they were quite strong as well. And that part of that is a bit of front running with respect to the fact that they are starting to position themselves with respect to getting inclusion in some of the indices. There's mixed feedback coming back so far as to how well they've done in that exercise. But they're definitely going in that direction, and we've got a very smart management team, and I would expect them to be successful. The timing of which is maybe in question, but I think they'll eventually get there.
Okay. Good to hear. So looking forward, we would be remiss, I think, pretty well in every one of our podcasts that we've been recording the last few weeks. We've got to talk about Trump. You've already mentioned him from a deregulation perspective, but tariffs, again, the threat's still looming. Any perspective in terms of Trump's threats of tariffs, if they're fulfilled, what that might do to the financial sector, maybe on both sides of the border?
Yeah. So in the Canadian context, just as it is with the rest of the economy on the finance sector, it would have a material negative impact on the sector because of the leverage play that GDP has against the financial outcomes for the finance sector. Whereas in the States, they're much more insular with respect to their concentration within the U.S. market at the end of the day. And generally, I think these tariffs, in context with all of the other elements that Trump is trying to impose, would be, I think my read on it would be relatively GDP neutral, or certainly wouldn't have the same effect on GDP as it would in Canada. So we're trying to tilt the portfolio to more of a U.S. exposure. And obviously we're tax sensitive, so we do that at a very measured pace at the end of the day, with respect to timing and with respect to magnitude. So we still are more Canadian focused because of the currency issues that are out there. But at the end of the day, that tilt towards the U.S. exposure should be good. And then that should set us up for another trade down the line as some of the noise disappears, hopefully. And so we'll see how that goes.
Yeah, and I think it's important to stress here these are more adjustments than any wholesale move, right?
Yeah,
and
that's right.
And it's so difficult to tell because even if, as we're recording this, again, the threat is looming, maybe next week, next month, and even if they come on, I mean, if we look historically what's happened, a lot of exceptions start to come back up. And again, my mantra is sanity prevails. And so, yeah, I mean, one thing we're not going to do is any whipsaw moves based on, what happens even next week or the next month. These are more just adjustments and the like.
That's right. Yeah. So, so I think you're right. Sanity prevails at the end of the day. And while it probably still just the mere fact that the discussions have come up in a material way, would lead us to believe that there is going to be some effect on the Canadian economy. But I don't think at this stage it's that material unless the tariffs really come to fruition at the end of the day. So this tilt should help us. This tilt is probably positive ex-tariff or not, just because of the U.S. economy, which is performing extremely well. And so we want to capture some of that opportunity.
Any other headwinds or tailwinds that you want to talk about that you're keeping an eye on?
Yeah, so I think the one sort of thinking 2 innings to 3 innings out, I think there should be an opportunity to then refocus back on the Canadian banks. And when I say 2 to 3 innings, that could be over the next year or two. So there isn't, as you say, there's not a whipsaw here, but probably what's going to happen with the Canadian banks, as we get through this mortgage refinance wave in the finance sector, and a recession does not necessarily play out, and that's a big question. I don't necessarily know for sure whether a recession will play out, but if a recession doesn't play out, then I think, and the economy rebounds and gets through this wave of negativity with respect to the mortgage refinancing and the tariff threats, then the opportunity as the loan loss provisions, which have been building up over the past, call it 6 to 8 quarters with the Canadian banks, as they roll off, that's going to provide a major tailwind with respect to profitability. So, that tailwind, we're a bit of a laggard when it comes to sort of the North American economy. And so I think in the later innings, the Canadian sector is going to be where the opportunity prevails.
Right.
So that I would say would be the major tailwind at the end of the day. The rest of it is really, as I said, GDP focused and interest rate focused at the end of the day.
Lee, thanks for this.
No problem.
Folks, as always, if you have any questions, don't hesitate to reach out to your financial advisor at your accounting firm. Talk to your TriCert Investment Counsel portfolio manager, or don't hesitate to reach out to myself. Take care.